Okay, it's 2 minutes past. We'll get going now, and the others can join us on the way to where we're going. So firstly, thank you very much for joining us today. Just to make sure you're in the right place, today we'll be talking about the new banking fellowship subjects that have been launched in conjunction, well, between ASSA and the IFoA. The new banking subject will be available from May 2022. And today we'll just be giving you an overview of the journey to getting to building these two new subjects, as well as what you can expect from the material. So at this point, I just firstly like to start with some housekeeping. So to begin, we have our disclaimer note from the IA, our host for today. And it's worth pointing out that you should put your Q&A questions in the box that's below, and we'll answer them where appropriate. We'll try and answer them towards the end, but feel free to pop them in at any point in time. At this point, we're just going to take a welcome message from our opening speaker for today, Tansui Chi, and you'll know him as the past president of the IFoA. Let me just stop sharing my screen. All right.
Inviting me to speak on this happy occasion of launching the ASSA and the IFoA Fellowship in Banking. I joined the IFoA Council in 2017, and very quickly, I met like-minded actuaries who believe that we should reposition and transform the profession to meet the demands and opportunities afforded by the digital revolution and the wider fields in order to ensure our continued relevance, influence, and impact. We also knew this is not just a question of providing new skill sets like data science and machine learning to our new generations of actuaries. We have also to encourage new mindsets and diversify our mindsets away from our quintessential mindsets of reticence and cautiousness, and to include mindsets of innovation, entrepreneurship, courage, and imagination. With the new skill sets and mindsets, we believe we will be able to perpetuate our relevance not only in our traditional domains, but also extend our influence to new ones, like healthcare, biostatistics, financial and insurance digital platforms, and of course, banking. This is the continuing wider fields argument, which has occurred in our profession in the last 40 years. In our strategy work, we debated the DNA and definition of an actuary, our orientation towards mathematics and its application in practical and organizational settings, risk and modeling, appreciation of uncertainty, and the use of judgment, and a strong sense of ethics were the additional building blocks. Hence, the vision, skill sets, mindsets, and domain strategy, VSMD, was born. In our debates, the extension of our interest to banking was a natural one. For me, two events made what was a natural case to a compelling case. I already knew actuaries were already active in banking in South Africa. In November 2019, at the IAA conference in Tokyo, I had a good fortune of meeting Conrad Breckenberg. He gave me a rather detailed story on how actuaries got involved in banking in South Africa, and he persuaded me that this was a very achievable goal. 2 months later, in January 2020, I had the pleasure in meeting Ian Allen at an advanced machine learning course at Case Business School in London. He lobbied me hard on the need to introduce a banking fellowship. I needed very little persuasion. I jumped at the opportunity and told him literally to get on with it, and that I would use my presidential office to support him actively. Ian, his wife, Fiona Allen, as well as the late Mahindara Davanjari, were not only ardent supporters, but they put in their heart and soul to bring this initiative to life. I would like to recognize all three of them as the early movers and pioneers of this initiative. They were well supported by Dick Ray and Kujai Chigiji, committee chairs of the IFoA and ASSA respectively. And of course, the executive teams at IFoA led by Clifford Friend and Chris Bristow, and at ASSA led by Conrad Breckenberg. Thank you all for your sterling efforts and dedication. This banking fellowship is an important demonstration of the VSMD strategy in action at the IFoA. It underpins our desire in opening up the opportunities for actuaries, not just in our traditional domains, but also new ones, in our continuing efforts to ensure the profession's continued relevance, influence, and impact at our workplace, in the industry, and in the society at large. And finally, I'm confident there will be similar announcements pertaining to data science and sustainability programs in the months and years ahead. And with this, I close my remarks, and I thank you for your attention. Have a good conference. Thank you.
Great. So I think with that, we'll launch into the presentation to give you more details. And yes, first, if you're wondering who I am, my name is Kujai Chigiji. I chair the ASSA Banking Committee, and I sit on the IFoA's Finance and Investment Board in charge of banking and DI initiatives. I'll let my fellow panelists introduce themselves. Over to you, Jerome.
Hi, everyone. I'm Jerome. I've worked in and around the banking industry for over 10 years. I've worked across retail, commercial, and wholesale banking. I've been involved with the ASSA banking community for over 5 years. I've been involved heavily in education through volunteering. This includes course materials, syllabus discussions, and examinations.
Hello, I'm Ian. I've been involved in banking for more than 30 years, but during that period, I've had 3 quite different careers. The first career was working for UBS in investment banking, in my case, sales and trading, particularly contacting central banks. The second career was in my home country of Scotland, working for the Royal Bank of Scotland as head of strategy, involved in a broad range of banking activities across retail, corporate, investment banking. In the third career, in the last 10 years, I've worked as an independent consultant. In the UK, we've had a very vigorous fintech industry, lots of new entrants to banking. I've helped a number of them with their applications where central issues are capital and liquidity adequacy. Students sometimes ask me, what would they recommend for them? From my experience, looking back at these 3 careers, I enjoyed them all. I couldn't choose between them. I'd be happy to do any or all of them again. One final point from me at the beginning, throughout that career, being an actuary has not been a requirement for the job or important in the job. But I'm happy to report that I've found being an actuary has been appreciated and respected. Thank you.
Hi there, I'm John Young, and so I actually started my career in life insurance, where I did a lot of traditional jobs for 6-7 years. And then I joined Ian Allen at the Royal Bank of Scotland in group strategy. And I was in the bank for 15 years, moving into roles in the retail finance division, and then into data and analytics, developing pricing and customer volume metrics across the bank, which relied pretty heavily on a lot of actuarial skills transferring into banking. And since then, I've been involved back in general insurance with a small family company through Lloyd's of London. But I still remain really interested in the opportunity that banking offers to actuaries in the future. Yeah.
Hi, everybody. I'm Kieran Hudsenberg. I've been working in banking industry for about 7 years now, mainly working in the retail space, but also the commercial space. Some other specializations, mainly working in credit risk, looking at the IFRS 9 modeling components. And I've been part of the ASSA Banking Committee for just over 2 years now, mainly looking at the education and obviously quite heavily involved with the redevelopment or the launch of these fellowship notes. Yeah, looking forward to having a good session today.
Good day, everyone. My name is Christian Opperman. So I've actually worked as a commercial broker in my first year, very interesting. And then I went into credit risk and capital management at a Big Four consulting firm for about 4.5 years. And then very recently, I joined a retail bank in South Africa, which acquired a small business bank about 2 years ago. And now essentially part of that team building up the business bank in costing as well as provisioning. Did obviously be involved with ASSA in creating the new banking notes, and very excited to see where we are going to take the actuarial field in banking in the future.
Fantastic. Thank you, gentlemen. And on that note, jumping into the presentation. So I'm sure you've heard a lot of statements of what an actuary is, what an actuary should focus on, the kind of impact that they have on the economy, and some of the statements that are quite common in our profession are that we make financial sense of the future. We are risk management experts. One that's very common within assets that we serve within the public interest, and also that we influence financial services and the economies that we work in. And all of these are true, but you can imagine if we claim to do all of these things, then why have we limited ourselves only to insurance and pensions, which do not actually encompass the whole financial services sector? If you think of risk, there are many risks to manage within a bank. If you think of financial services, banks make up at least 50% of financial services in any country. If you think of public interest and the many events that we've seen across the globe, banks have been at the forefront of solving these issues within financial services. So one of the themes, I guess, for us going back over a decade was, why aren't there more actuaries working in banks if we claim to do all of the above?
So this slide shows why everybody who's been involved with ASSA to produce the banking exam, I guess, has been quite so excited. And it's quite hard to find information on insurance versus banking. But whichever way you cut it, it's a really big opportunity for actuaries. And this slide, it shows a developed economy, in fact, the US, and there banking is at least as big as the insurance industry as a potential employer. So it doubles your chances to find a job. Just think about that in a developed economy. But as we look wider in Asia and South America in particular, insurance has been less developed. And so that then means that banking is going to be more important for students in these parts of the world. So frankly, we think it's a real opportunity for the actuarial profession going forward. Next slide, Kudzai. And the other thing is, it's just vital to the economy. And this is something that I only realized after I moved into banking and joined Ian Allen at RBS. But when I was in group strategy, I realized how systemically important banking actually is to the economy. And this is because banks play a key role. They lend to businesses and they lend to consumers, and that in turn supports economic growth. And I would go as far as to say that, in my view, banking really is the beating heart of capitalism and a capitalist economy. But there are challenges there. Economies and banks influence each other. So when economies are performing well, credit losses tend to be low, banks are profitable. But during a recession, credit losses will rise. And this can create a feedback loop. It's a little bit like, the general insurance cycle that you get, where you get the pricing of general insurance and supply and demand affect each other. But in banking, it works because banks actually create credit. So when economies are growing, credit losses are low and banks lend more, encouraging economic growth. And that continues until something goes wrong. And then credit losses rise, banks start making losses, and they start to cut lending. And that actually causes the economy to shrink, creating a downward spiral. And this is the factor, this feedback is what makes banking especially interesting as an area to work in. And the thing that's interesting, but also potentially good for actuaries, but I wouldn't go around saying it too loudly, is the fact that every crisis is different. So the crisis we had in finance and banking in 2008 has been really different from the problems and the challenges caused by COVID-19. And it'll be really different from the next crisis that appears. You know, in banking, there's always going to be problems because of this feedback loop. But the good thing is that actuaries have the skill sets to help banks navigate these challenges and to make decisions in the face of uncertainty. Thanks, Pijay.
If we look at the traditional areas of actuarial expertise, some of the big ones that pop up is home insurance and car insurance. In the US, that would be called PNC. In other parts of the world, that mainly covers general insurance. Life insurance, which we consider also home ground. Obviously, pensions is one of our early entry points. And we also have health insurance and investments. Health insurance, I think, is the more recent one prior to banking. Before that was general insurance, and then life and pensions have been around for a while. And to the point made earlier is the fact that, and Sweet Chi said this as well, that actuaries were working in banking, not just in South Africa, but in other parts of the world. In South Africa, we're now close to about 15% of actuaries and actuarial students working within banks. And in Australia, that's around 10%. It could be slightly more, but a few years ago, I was saying at 10%. And what we found is also what's not pointed out on this slide is that in South America, banking is taught as part of the undergraduate studies of actuarial science students. And we're starting to see a few people here and there across the UK and the USA as well, venturing into banking. And I guess what's heartening about this was the fact that, I guess for myself, going back about a decade, it was the fact that as much as this was a non-traditional area, others had done it and were doing it. And we're going to talk a bit later about how the likes of Ian and John had been working in this area, Ian since the 80s, John since the 90s. And, you know, we joined a lot later, but it was clear to some of us that we had value to add and that the profession was moving in this direction and we were starting to pick up critical mass.
It's good, Zai. As John said, banking keeps on changing. So it changed at the beginning of this and it's changing now again because of the digital revolution. Up to the 1980s, in many countries, banking was branch-based. People would leave school, go down the road to the local branch, get a job, and if they worked hard, they might become branch manager or area manager or move to head office. So in the 1980s, I remember clearly in the UK and the US, many large banks involved in what they called business re-engineering programs, where they centralized many functions and reorganized themselves. So, for example, of interest to us, risk, instead of being a local cottage industry, became a centralized function. People were gathered together and data was gathered together. In the reorganization of the business, many of the people who had been branch or area managers felt uncomfortable with the changes, and banks were looking for new people to fill new roles as they were reorganized. And that was the background that led to me going to RBS as head of strategy in the early 90s. In that period, I recall a number of other actuaries moving into banking and achieving pretty senior positions, but disappointingly, the number was quite small. So in the 1990s, I joined RBS. I set up a members' interest group at the IFA, and I did, with a number of colleagues, present a sessional paper in, I think, 1998. So over to you, John, for the next stage.
Yeah, so I joined Ian in RBS. And a few years after that, when I started to realize what a big opportunity banking was, I picked up becoming chair of the members' interest group that Ian had set up. And my aim was to try and create a community of people who worked in banking. And I also wanted to propose the banking exam, and it went as far as actually creating a syllabus and submitting it to be considered by the UK profession to move forward and to try and get critical mass of actuaries in banking. But unfortunately, the timing wasn't right then in the UK. And that then really left the field open for ASSA to develop the opportunity for actuaries in banking. So, Jerome.
Yeah, so moving on to the 2000s and 2010s, this sees a growth in the number of actuarial skills working in banking in South Africa. So this grew the need even more for a specialized education qualification. And after many years of deliberation and around 3 years of course development from the team at that time, the ASSA Banking Fellowship application course was completed and launched in 2015. This course was developed with experts across the globe. The first sitting in 2015 was quite a memorable exam in that it was a 0% pass rate. So during this period, more volunteers started coming into the banking community and drove banking to be one of the more active committees or communities at ASSA. The idea was to introduce an applications level exam at that time and to introduce a principles level subject once banking actuaries passed through the exam, volunteers' capacity increased, and the demand is assessed. What's that?
Well, at some point we realized that we're starting to see some good results. As Jerome mentioned, the take-up was picking up and the pass rate was starting to, I guess, level out with some of the other subjects. And around that time, I had sort of the great, I guess, fortitude of meeting up with Ian at the IAA in meetings in June 2018 in Berlin. And we got talking. This is a space he'd been working in for a very long time. Michael Tichera, who was the chair before myself, was there, and I was there. So I guess you could call it serendipity. And we exchanged notes and we started working together. Subsequent to that, I joined the IFoA's banking working group, member interest group, and some of their other working groups. And we started really talking about what the potential of working together could be. And I guess after about 2 years of weekly meetings, we figured perhaps let's do a formal investigation into what a partnership could look like and what banking education for IFoA could possibly look like in the future, with all options on the table, including the ASSA Banking Fellowship subject. And after months of deliberation and input from other SMEs from around the globe, we concluded that it would be worth revamping the F206, which was the banking fellowship subject within ASSA, and adding a principles level subject to sort of round it up. We had the proof of concept, we had growing demand, and the supply and demand arguments made sense for us, and it just made sense. So we've been working together for just over a year on putting the syllabus together, as well as the notes for the new banking fellowship principles subject, and now the revised banking applications or advanced subject. In addition to that, we've introduced the Certificate in Actuarial Banking Practice, and that's available to all associates and all fellows of all full member associations of the IAA. We started offering it at the beginning of this year, but obviously with the new subject, that certificate now requires both of the subjects, and we'll talk about that a bit later. But I think you can see that over the past few years, we've really picked up the pace in terms of moving this practice area forward and, sort of legitimizing it and sort of within the global audience. And yeah, we're really excited about where this is going and how it's really picked up momentum.
So this graph shows the proportion of students attempting fellowship application exams in South Africa. There are approximately 400 attempts at fellowship application exams in South Africa per annum. The main point here is to highlight the accelerated growth in banking, and that can be compared to healthcare. And in South Africa, healthcare has been around for over 15 years, and banking has caught up in a short time. With regards to the other subjects, pensions are expected to remain low, and probably the take-up will remain low worldwide. The investment subjects, this subject historically has been taken by those working in banks. So in summary, it's showing really promising growth for banking, and we are hoping to increase this growth with the IFoA's partnership and hopefully a greater international focus.
Thanks, Jerome. And just to continue on the theme of what an important role banks play in the economy, this slide just lists some the global systemically important banks. And as you can see, the list is quite extensive. There's quite a lot of banks listed here. Just like, as I say, re-emphasizing the important role that banks do play in the economy. I think the other important fact to note is the diversity of banks. I'm sure you can see banks from all across the world. So there's definitely a lot of job opportunities, or there's definitely a lot of opportunities to apply your actuarial skill sets across these banks and these big banks that play very important roles in the global economy. So I think that slide just re-emphasizes that idea.
So, like Kieran just mentioned, banking is diversified. I mean, obviously across the globe, but you also have different type of banks, right? So just to name a few, or go through some of them. Obviously, you have your central banks that look after the bank, essentially the banks within an economy. Universal banks, most of them, your GSIBs, like Kieran mentioned, or your global banks, essentially investment banks providing financial services to their clients. Commercial banks, both looking at both retail and corporates. You see a lot of that, especially in South Africa, with the big banks operating on both sides. And then get some of your retail banks that essentially just provide services to individuals or small businesses. Community banks, big thing in the US especially. I think there's about 4,000 or 5,000 community banks. Essentially, they focus in a specific area and cater to the specific needs of a specific area and the clients. Then you have your neobanks, and many of these banks being purely digital, right? So some of the new banks coming up, Revolut, Bank Zero, Time Bank, and then you have your payment services, essentially non-banks like PayPal, Chime, leasing companies, where actuaries can really provide a lot of positivity or value.
Okay, so this starts to pick up the idea of what does it mean to move from insurance into banking? What does it actually feel like? So I was genuinely pretty worried when I first moved from a bank into, from insurance into a bank. I was worried on several levels. So RBS, when I moved to, was about 100 times bigger than the insurance company I was working at. So I expected banks to be very sophisticated. And I was also very worried about, would the knowledge that I'd acquired and put so much effort into acquiring apply in a new environment? But I very quickly realized, working with Ian, that everything I knew applied, but just with a different vocabulary. So within the banking exam, this has been solved with a glossary in the opening chapter. And that alone would help anybody who is going for an interview with a bank to take what they already know and put it into banking language. And the slide here just covers, many areas. I'm not going to go into them in particular, but you'd have underwriting in general insurance, or insurance more widely. It's just equivalent to credit scorecards in banking. You've got provisions in banks versus reserving in insurance. And for the work that I did, which was very heavily pricing related, these ideas just translated directly into pricing models. And you can think a little bit more about the types of roles that actuaries can do in banks. Thanks, Kujai.
So Kieran mentioned the large number of large banks. And looking at possible roles, this is what a typical large bank is like. Down the left-hand side, a lot of activities, many of which are the same sort of names you'd apply in an insurance company, but here in banks. And they're taking place either in business units in the central column, retail, corporate, investment banking, and so on, or on the right in central functions, group risk or group finance, or in my case, group strategy. So there are a lot of roles, many of which are pretty well paid in banking. For actuaries, the natural thought is risk management. So you could work in the risk area in a business unit, in retail banking or corporate banking, or you could work in the group function, the group risk function, which is bringing all the risk together across the business areas and doing things like the capital and liquidity assessment. But in showing this slide, our experience is that actuaries are not limited to the risk function. In my own career, I never actually worked in the risk function, but there were many other things to do. So down the left-hand column, we find actuaries are working in many of these areas, often solving problems. And the next slide, we think about possible role for actuaries in banking. And like John, I remember when I moved to RBS, there was a period of a year when I felt slightly not sure I was going to make it until all the language and behavior and things fell into place. So if actuaries are interested in banking, I think it's realistic to see a two-stage process. The first issue is to get a job in a bank. And secondly, once you get going and get comfortable, internal moves within a bank is normally quite straightforward, as John did when he came to work with me. Once he got his self up to speed, was able to move off into retail banking and product pricing and so on. If you are going for an interview in a bank, a key thing to be aware of is that it's going to be different from a traditional actuarial area. The key difference is that people will not ask, what exams have you passed, and so on. Their mindset is, what can you do for us? If you transfer your skills around to solving their problems relating to issues that are on this mind. So with that in mind, I think there are two routes into banking. The first is a transfer using your existing skills, such as product pricing, which John did. On the second is solving current problems, climate change being the most obvious one at present. So good, on the next slide, we look at some examples of moving from insurance to banking, building on existing skills and experience. John moved in product pricing, and although he may have been nervous about moving, he was very well received and much appreciated in different parts of the bank for his work on product pricing and customer value areas. Reserving for claims, many actuaries have added value on the right in provisions for expected credit losses, absolutely building existing experience, people working for banks, working as consultants. This has been a very straightforward route for actuaries to move into banking. Risk model validation, again, pretty direct transfer. It may be the models do slightly different things, more focused in banking credit risk, perhaps in retail and corporate banking, less focused on market risk, but the process with which you're familiar is directly applicable, and your credentials as an actuary add to your ability to do this job. Enterprise-wide risk management, sometimes I become a little bit nervous of overuse of the ERM phrase, but in banking, people do work in specialist units, sometimes called silos. It is an advantage that we are trained and have confidence to address risk across the business. And when it comes to the last two items, capital adequacy assessment and liquidity, asset liabilities, you need to understand all risks and pool them all together. So these are areas in which actuaries have moved from insurance to banking, and are areas, if people are interested in moving, it's quite easy to say, I've done this, and I'm interested in applying these skills in the equivalent area in banking. The other opportunity is problem solving. Now, many of us as actuaries, on the next slide, don't necessarily want to manage huge teams. Many of us like solving problems. And as John said, banks keep on facing new economic cycles and new problems. So on the top left, on this provisions for expected credit losses, this is applying an accounting standard. But the last 18 months have shown it's more than that. It requires the sort of understanding and judgment for which actuaries are renowned. That is, the worse the economy, the higher expected losses. Over the last 18 months, we've had this very uncertain economic outlook. And again, this week, over the last week, markets down because of the new variant. So you're forecasting expected losses with a very uncertain GDP forecast, not just an accounting exercise, understanding and judgment, very interesting for actuaries, particularly those who've been involved in reserves for claims, but not limited to them. The bottom right is another current area. It's called non-financial risk. That's the phrase used. What they mean is risk other than credit and market risks. In recent years, conduct risk has been a problem for some banks, cyber risk, IT failures. The cost of these events have been of the same kind of scale as traditional credit and market loss events. So regulators are strongly encouraging banks to focus on their understanding and mitigation of these risks. Some actuaries have very good experience in non-standard risks, either in life or general insurance, and are good at dealing with the uncertainty associated with these events where the frequency is low, but the cost can be high. And to underline the importance of this, in the next slide, this is from the Davos group, the World Economic Forum. The details don't matter here. Don't try and read the slide, but traditional risks, financial and economic risks, are in blue. As you go up the slide, you're moving forward in time up to 2021 at the top. So bankers are less worried about the blue risks. They feel that they still face significant credit and market risks, but they're under control. The slide is dominated by the green blocks. These are environmental, climate, and other risks where people are worried they don't understand them so well and need to do a lot more work on them, as they are doing. The purple blocks relate to IT and cyber risks, again, much more important. The red block at the top is the pandemic this year. So this is not an area which is uniquely of interest to actuaries. If you're working in these areas, you'll be working in a multidisciplinary team with accountants, possibly people from a legal background, people with PhDs in different specializations, but there are many interesting problems to solve. And in the same way that banks were looking for new skills when I joined in the early 90s, they are open to people who can help to address these new challenges now. On the next slide, we continue this problem-solving issue. Product development and pricing was an obvious lateral move, as John made. Now it's an area of heightened interest and focus because of the digital revolution. Much better IT, much more accessible data, partly with open APIs, new entrants to banking, including fintechs, more competition. There's a need for both the new entrant banks and the established banks to focus on pricing and customer value propositions. So this is a really dynamic area. 30 or 40 years ago, retail banking was not so exciting. Now it's a huge opportunity for actuaries. So I think, Kieran and Christian, you're both involved in this as well as John, aren't you? Kieran.
Yeah, thanks, Ian. I mean, as you mentioned, I think a few slides back, obviously, if you were transitioning from an insurance company to a bank, I think this is one area where your skill set can definitely be applied. I mean, here we look at building things like scorecards, which is very similar to, say, underwriting in an insurance space. So, as Ian mentioned, it's been changing a lot, using certain machine learning techniques, learning how to deal with big data analytics. So it's quite an exciting area to work in, building scorecards, which obviously then does your risk assessments. Then you can assign pricing and those sorts of models. So definitely an exciting space to work in.
And Christian, you mentioned you're focusing on costing.
Yes, so very recently started in a costing role, and it's quite interesting. It's not the requirement is not to apply a lot of, let's say, statistical analyses and forecasting, etc. at, let's say, very high analytical level, but there's a massive demand for just applying common sense and just for people that has got very good analytical skills to take a quite simple quite simple, let's say in our sense, issue and essentially just applying logic to the problem and coming up with solutions. It's a massive demand that I can see in the bank. So, yeah.
On the bottom left is what I might focus on as the most interesting opportunity over the next few years once we get past the residue of the COVID problems, climate change stress testing. This is a new area for banks to face up to. For them, the challenge is long-term stress testing. The regulators are starting this year to require banks to think about stress testing for climate change over 30 years. Their normal experience is 3 to 5 years. Whereas actuaries are trained to think in those timelines and have obvious proven skills in stress testing. As I said, this is not an area for actuaries alone. This is teams of people with competence, but this is a new area. So the barriers to entry are lower because even if bankers have worked in banks for 30 years, their experience doesn't give them much advantage. The future will not be the same as the past. And I do find a number of actuaries either are moving into banks to work in climate change stress testing or have moved into banks and are being assigned to this area. Now, Jerome, you're working in this area, aren't you?
Yes, that's correct, Ian. I am currently developing some of the frameworks for climate scenario stress testing and related analytics at a large bank in South Africa. So in-depth or focus climate risk stress testing exercises are fairly new globally. For example, I've been involved in the South African Reserve Bank's first exercise for a quantitative approach to climate physical risk on its loan book. This exercise was done across the banks in South Africa. And similarly, the BOE and ECB have conducted these exercises in their jurisdictions. And to highlight some of the accelerated importance, the BCBS has introduced a consultative paper, the Principles of Climate Risk Management, just the other week. Thank you.
On the top right, I'm just reminding us that a lot of actuaries work as consultants and prefer focusing on a particular area, doing it for a number of clients and becoming an expert in that area. So for actuaries who are consultants and are moving into banking, we should not forget community banks, smaller banks. It may be less glamorous than the large banks that Kieran showed us, but they face real challenges in moving to the digital age. From my experience, I think it's very important that we continue to have diversity of banks. If we don't have all banks looking the same, and actuaries do have this ERM understanding of risks. And so we are able to support these banks across the range rather than them having to recruit specialists in the different risk functions and capital liquidity. So for consultants, that is a very interesting and obvious opportunity. And at the bottom right, fintechs. as I say, when I started in banking, it was being transformed by business reengineering. Now all of banking is absolutely being transformed by new technologies, most obviously in retail banking and the fintechs offering innovative products. But the regulators are encouraging banks to get end-to-end data to enhance their core systems. So lots of opportunities for fintechs providing services to banks and competing with it. Now, among our group, Kudzai, you are our fintech expert, aren't you?
I don't know if I'm an expert, but yes, that's essentially where I spent most of my time the past few years. So when I started off in banking, I actually worked in IT. It was always hard to explain to people that I'm an actuary who largely works in IT. So I was brought in to work on mainly the digital R&D projects, essentially building digital services for the customers. And I guess the actuarial component in that is that everything needs to be priced. You don't just launch into the abyss with an idea. Everything needs to be priced. You need to understand the impact on the book. And whatever digital service you create is still fundamentally, has a parallel in the non-digital space. You're just sort of changing the customer experience and hopefully reducing overheads and increasing uptake by taking an omni-channel approach. So I guess, I got my start in tech in banking. So didn't do a lot of the traditional banking work, even though banking is not considered a traditional space. And I think my actuarial skill set served me very well because, like I said, I was still essentially pricing and even brought in a lot of the knowledge from the reserving space within life and insurance and healthcare, where I'd worked before, into the environment, and also working quite close with a lot of the CRM teams, and I learned, I guess, a big part of the business and a lot of the skills in terms of, understanding data structures and architecture, the analytics component, also being able to do very quick back of the envelope calculations in meetings where a lot of quick decisions need to be made. All of that came in quite handy within banking. But I guess after leaving corporate banking, sort of the formal banking space, I have been spending a lot more time in sort of the pure fintech startup space. And there are a lot of close parallels. So I believe that for a lot of actuarial students and qualified actuaries, fintechs, I think, are also ripe for the taking. I'm always saying banking isn't just about banks. If you think about your point, a lot of fintechs are in the payment space, and guess what? Retail banks fundamentally make their money off of. It's payments, and there's also loans as well. There are a lot of fintechs that just focus in the loan space at the moment and are doing very well. All of that requires the same skill sets that you'd need in a bank. And you'll see that some of the much larger fintechs that are, I guess, no longer startups and looking to list and, are in Series D or beyond, are looking for the exact same skill sets that a bank would be looking for in a lot of these departments. And this isn't just at a quantitative level, but also at a more strategic and senior management level. Yes, over to you, Ian.
John, next slide.
Okay.
Sorry.
Oh, no, what, back one. Perfect. No, forward. We've straddled. So just forward one slide, that's it, perfect. So this slide encapsulates how I would think of traditional banking. And hopefully what it conveys is the fact that banking is fundamentally really simple. A bank is just a balance sheet. So you bring in deposits, which the banks call liabilities, and you make loans, which the bank calls assets. And it makes a profit by the margin difference between what it charges customers to borrow and what it pays depositors to attract the deposits in. But the simple model is enough to highlight some of the key banking risks. So from this, you can pick up very quickly credit risk, which is the risk in the asset side that you don't get your money back. You also have operational risk. Banks operate, tens of thousands, potentially millions of small customer accounts. So if they fail to manage those accounts properly, if there's a data breach or if systems go down, that's your operational risk in a bank. And you also have market risk with other assets, which is the value of these assets fall. The simple picture as well, as an actuary, you very quickly realize how you manage these risks. So a bank, like insurance, you hold capital against unexpected losses. So it's effectively an exact mirror of what you do in insurance. What's slightly different is you hold liquid assets that can be sold if you get a run on your deposits. If people withdraw deposits, the bank can sell these liquid assets to pay the depositors the money that they want to withdraw. Next slide, thanks. Sorry, next slide, perfect. So the great news as well is that there's actually a lot of other risks for actuaries to understand, explore, and get involved with. And a lot of these have additional detail underneath. So if you think of credit risk, it actually also includes things like counterparty credit risk. And this is the risk that if you have a derivative, let's say you have an interest rate swap, there is always a risk that the other side of the contract might get into financial difficulty and might not be able to honor that contract. So the bank actually has to manage its relationships with all of its counterparties. You also have potential concentration risk with credit. So the example that springs to mind here would be if a bank held a 10% share in a company like Enron that goes bankrupt, that bank will suddenly find itself in a lot of difficulty because it has a sudden concentrated credit risk. And on the liquidity side, liquidity risks arise when customers panic and want to withdraw money, and it can be managed with the asset and liability matching. So liquidity risk arises because assets and liabilities are mismatched quite deliberately by a bank. But as an actuary, you can understand the trade-off of profitability and risk that the bank is taking in doing that. So the banking exam will explore all of these areas and all of these risks and how to manage them. And as we've heard from Ian and others, some jobs in a bank will focus on very specific risks, such as credit risk, where we take our existing skills and we translate it into a banking context. But from my experience, I would very strongly say that actuaries are unique in their ability to actually think across and bring all of these risks together. This is something that banks find quite difficult. People tend to work in silos in a bank, but actuaries can bring all of these risks together and start to make judgments and advise senior bankers on the trade-offs that decisions will incur between the different types of risk the bank is running. And while I was doing my day job, I was very often landed with different projects that spanned all areas of the bank, where this was a specific actuarial skill set that they were after. They knew that I wasn't an expert in any of these areas, but I could advise the senior people on the implications as they thought across all of these risks. Thanks, Gudzai.
A lot of people have asked us how we decided what should be in the syllabi for the two subjects. Well, I guess we're lucky that we had the original banking fellowship application subject to work with, which was developed about 9 years ago, as Jerome mentioned earlier. But we had to go back to the drawing board to understand what would fit into a principles level subject and what should stay within the applications or advanced subject. And one of the key ways that we thought about the two subjects was, one is focused on measurement and the other one is focused on management, and really making sure that the principles level subject didn't require expert knowledge. So like any of the other principles level subjects, you should be able to write it without ever having worked in eBank. But it gives you a lot of the foundational knowledge that makes it easier for you to make that transition. And we maintained a lot of sort of the advanced and applications level knowledge that required you to have domain expertise, as is expected with any of the other fellowship subjects. So the team that put the syllabi together is everyone who's on this panel, plus one additional gentleman, Dick Ray, who was the IFoA's Finance and Investments Board Chair at the time and was leading the banking MIC. So between the 6 of us, 7 of us, we spent about 5 weeks really panel beating these two syllabi together. And this was also off of the back of about 2 years worth of discussion. So we'd had a lot of back and forth between Ian, myself, John, and Dick as to what sits where. And I think what was, I guess, quite gratifying at the end of the subject, looking at the two, is that it is very parallel to what you'd see in any of the other subject matter areas. And I guess great thanks to Christian, who sat down and did a lot of the grunt work in moving all the bits and pieces of paper back and forth to giving us the final product.
So this is just one example of a chapter in the exam. So it's a new chapter that's been added. And it reflects, for me, it reflects a lot of the skills that I've actually brought and used directly in my career in RBS and banking. And I'm under orders to not speak too longly on this one because I get quite excited about it. But you've got, for loans and loan pricing, it's just a lift and shift of traditional discounted cash flow techniques. So for me, it was just a lift and shift of everything I'd done in life insurance. Deposits are actually surprisingly interesting. You know, you use deposit accounts all the time individually, but when you look at it from the other side, from being a bank, you can suddenly start to use concepts of price elasticity to understand how you design your products and how you price them. And it turns out to be a lot more complicated and a lot more exciting than, you know, you'd originally imagined. But fundamentally, I think if you read the chapter in the exam, you realize that there's nothing more complex than you've covered already or already done if you've worked in a traditional actuarial pricing role. Thanks, good time.
Yeah, and just in terms of the credit risk measurement chapters, I mean, John has alluded quite a bit to the fact that credit risk is one of the biggest risks that that you would be exposed to in a bank and the banks try to manage. So just in terms of the chapter itself, so one of the concepts or the key concepts that we look at is this idea of IFRS 9 or provisioning for expected losses. So we do talk about the transition from IAS 39, which is the previous regulation, to IFRS 9, and the impact that had on your impairment figures. We also talk about the credit loss concepts, or that one would need to estimate in trying to get into your expected loss figures. So we look at probability of default, we look at exposure defaults, and we look at loss given defaults. And a lot of these terms or terminology is it's quite similar to what you would experience in an insurance space, where you look at expected claims and probability of claims and those sorts of things. The other thing we also look at are your capital requirements. So we look at the Basel regulation and the Pillar 1 minimum capital requirements, and how you build models within say a retail or commercial space, and the different approaches you use. So some banks are allowed to follow standardized approaches, whereas bigger banks with more data are expected to follow more internal ratings-based approaches. So we look at those different approaches. And then I think one interesting concept, and again, John alluded to it earlier, is that I think traditionally when people think of credit risk, we obviously look at credit risk in the banking book, where we lend money and there's a possibility that the counterpart will not pay. But what's becoming increasingly important, especially in the revisions to Basel III, is trying to understand and quantify and manage credit risk in the trading book. So here we look specifically at counterparty credit risk. As John mentioned, obviously in a derivative contract, there is always the possibility that the counterpart will default on any obligation. And we also look at credit valuation adjustment, or CVA, which is essentially trying to quantify CCR, or your counterparty credit risk, and hold capital against that. So these are just some of the high-level concepts that we do cover, that we at least try to cover in the credit risk measurement chapter. Thanks, Kutsa.
So in the liquidity risk management or measurement chapter, what we look at there is the LCR, or the liquidity coverage ratio. Essentially, it's a ratio to measure if you have enough liquid assets or assets that can be converted into cash to essentially cover net cash flow event or stressed cash flow event over 30 days. So if you think about it, corporates might withdraw their deposits, meaning that you would now need to have this cash available to pay out to them, right? So essentially, in a stressed environment, do you have enough cash available to make sure that you can service essentially the withdrawals as well as on the loan book side, drawdowns from customers that have limits available. That's good, Zai.
So the treasury management chapter, those that are familiar with the content, this chapter has been streamlined quite a bit from the previous versions. The content looks at the treasury function and possible treasury function structures of a treasury function in a bank. It discusses the concepts such as borrowing short and lending long, describes the Asset Liability Committee and how this committee manages or monitors risks and its risk-related concepts. Some of the risks and functions it looks at includes interest rate risk, foreign exchange risk, capital management, funds transfer pricing, and stress testing. Thanks for that.
So just commenting the chapters on capital management and strategy. On capital management, as Kieran said, the Basel regulations specify minimum capital requirements. National regulators in different countries may require banks to hold additional amounts. And then for actuaries, the stress testing to allow for basically a macro recession or other adverse events leads to the quantification of a capital buffer that banks should hold on top of their capital requirements. On the chapter on strategy, it deals with a number of issues, including that within any bank, there is an important process each year, the annual review of strategy by the board, and then during the year, opportunities or threats arise, and you need to respond to them. We also deal with mergers and acquisitions and current strategic issues. Now, in these two chapters, they come towards the end of the applications or advanced course. We've already done the principles, we've done the measurement and understanding the issues, we've done the management of them individually. So these chapters are essentially about bringing everything together and seeing the overall view of the bank. I would hope that these chapters would put an actuary in a pretty good position to work in the team on these topics, that is to work on the ICAP, the Capital Adequacy Submission to Regulator, or in strategy to work on the annual review and the response to events that arise. These are practical chapters which prepare you for working in these areas.
Okay, on that point, I'm sure a lot of you want to know what the education material will look like. So first and foremost, we're following a very similar, I guess, process and structure to what you would see with any of the other fellowship subjects. The idea was to really bring it in alignment and to standardize it so that it doesn't look or feel a lot different. So first of all, there are course notes, and the course notes include a Q&A bank at the end of every chapter. And there's also a marking option. So once you register for the exam, you can sign up for tutorials and you'll get questions and they'll be marked by one of our SMEs. There's also a specimen exam paper that's available if you've purchased the notes. And there are mock exams that are available about 3 months before the exam is written. For the advanced or application subject, we also offer classes, and these have been around since the subject was originally offered, so about 7 years ago. And the reason we have these classes, they're online classes, they're like tutorials almost. The reason we have these classes is so that you can get some contact time, some face time, although digitally, with subject matter experts who've worked in banking, and you can discuss a lot of, I guess, the hairier issues that arise in a bank. And we have found that this is particularly useful for students who are writing the applications for advanced subject. And initially, it was provided as a bridging option to help students who hadn't worked in banking for a long time, and because there wasn't a principal subject. But even though we now have a principal subject, we're keeping these online tutorials in classes so that everyone can get a chance to get some real life examples sort of drilled into their heads and to discuss the issues. And then there's the certificate in Actuarial Banking Practice, which has received quite an interesting amount of attention. The idea of introducing the certificate was really around the fact that, well, firstly, there are a lot of actuaries who are post-qualified, who are already fellows, who didn't write a banking subject, but would still like to and get, credit for that. And also the fact that there are individuals who may belong to another member association that's not the IFoA or ASSA, but are interested in working in banking and would like to write the subjects and get some kind of accreditation for it. For some people, it's not enough to just write the notes. They would actually like to get a credential that is globally recognized to be able to do that. And as you can imagine, it's not like we can sign a lot of deals with different member associations overnight. This is a lengthy process to get all the approvals. In the meantime, while we're talking to other member associations, literally any fellow or associate of any full member association can approach us to write the exams, and we'll be providing further details on that as time goes on. And finally, the exams are online, so you do not need to travel, and they're accessible wherever in the world you are, whether you're writing the exams for the certificate or for the fellowship subject. And you would just need to coordinate with either ASSA or the IFoA if you're an IFoA member. And then in terms of CPD, so we've gotten a lot of questions around CPD, especially for those who have quite a lot of experience in the space and are already fellows or associates. The IA Banking Forum holds events right throughout the year and has been doing so for about, I believe, 6 years now. And the ASSA Banking Committee also holds a couple of events during the year. Our flagship event is our annual seminar, which provides at least a full day's worth of banking-related CPD content. And we have the newly created IFoA banking community. And if you're an IFoA member, you can get access to that for free. And on that platform, they give you access to sometimes almost weekly events. But typically, there's at least an event a month that's available there. And then finally, you should be pursuing CPD opportunities with any other institutions. So whether they're in the banking or finance space, as long as you find that it's suitable for you. Banks have been around much longer than actuaries have been, so we do not proclaim to know everything. And we do encourage cross-pollination of ideas. So whether it's an event with GARP under the CFA or FRM, whether it's with an Institute of Banking or with the World Bank, wherever it is, please do register those events as part of your CPD. What's nice about the way CPD is done nowadays is that you need to provide evidence of what you've learned in the event. So it's less about it being sort of actuarially inclined, but more so, was it relevant and informative and useful for you? Over to you, Ian.
As Tan Sri said, his instructions to get on with it applied to the development of banking fellowship courses. When we started, we hadn't thought about the IFoA core subjects, but we were very fortunate in the group of people working on this. There were people of different ages and nationalities and stages in their careers. And some of the younger people who were still sitting the exams or had completed them quite recently were keen to include references to banking in the core subjects. So the next challenge then was to raise this with the IFoA module leads in education actuaries. And I can't thank them enough for their positive response to what seemed like a bit of extra work for them. So we agreed with them that we would make suggestions about where references to banking could be included in the existing courses without requiring any change to the syllabi that had been improved. And just mentioning a few examples here, CM1 in red, there is talk about products and pricing. So some of the products were in fact banking products and banking pricing without much reference to banking. So only a little bit of fine tuning. On the top, CM2 does talk about provisions for expected credit losses. It talks as if it were in a generic context, but obviously we can point to the importance of this as central issue in banking. On CB1, it talks about insurance capital and insurance company accounts. So it was not difficult to suggest additional paragraphs with equivalent information about banking. And CB2 on the bottom right, the paper does cover what we would consider banking issues, including asset bubbles and banking crises. So as well as doing the fellowship courses, we have made these suggestions, which generally are just a few paragraphs, but would encourage students sitting the core subjects to recognize that the skills they're acquiring will have applications in banking as well as in insurance and pensions.
So finally, and I think we're right on time, those who've asked sort of what happens from here. So obviously, we're hoping that there'll be a good take-up of the subject, and we expect that to take some time, maybe a couple of years, but we're quite hopeful on that. We'll be looking to partner with more member associations. So discussions have already begun with countries like Australia, India, the USA, and we're looking to just expand the arrangement we've developed with the IFoA to other member associations, and also supporting them in building their own banking offerings if that's the route they decide to take. We'll be hosting a lot more CPD events, especially since we'll have a lot more time from next year onwards. And one of the key components, I guess, of our strategy is to build the demand pipeline. So that involves talking to employers, and that is both senior executives and their human resource executives, as well as engaging with regulators. I think one statement from the regulators we've seen in South Africa can make up for probably years worth of pounding the pavement. Them recognizing our skill set is quite important, even if it's not officially in regulation in the form of a statutory role. Them recognizing our role is quite important. So for us, it's really still day one, and we really do look forward to engaging with you and you taking on the subject, you coming to the events, and really becoming a part of the community and exploring your options within the banking space. And on that point, thank you very much to my fellow panelists and our team from the IAA and ASSA for assisting in hosting this event, and to all of the attendees for today. Thank you very much for making the time to join us. At this point, I think we'll take a couple of questions. I know some of the panelists need to drop off. That's all right. I see we have one question from Kathy, which we can answer very quickly. And then if there aren't any more questions, we can wrap up for the day. So Kathy's question is, can the panel comment on actuaries working in developing banks, central banks, and the World Bank? Do their different roles create different perspectives for actuaries? Maybe Ian, you can start.
Yes, I think that it's a very sensible question, that in talking about the opportunities, we've talked about retail and corporate and investment banks and actuaries and consultants. Another obvious opportunity is working for central banks or supranational banks. I don't think the pros and cons are any different. It is applying our skill set to the needs of these organizations. And it really relates to what John was saying, that the people who would add value there are likely to include people who are interested in financial stability, the impact of economies on banking, or recently COVID-19 on banking, and the regulation and management of banks through these ups and downs of the economy. So I do like the question, because when I look back at my career, I've enjoyed the different experiences I've had, but sometimes I wish I'd thought about working or offering or seeking to work for the Bank of England or some such organisation. Given our commitment to the public interest, it would be a very rewarding thing to do for at least part of a career.
Yeah, definitely. John, do you have any comments on that before we
Yeah,
go
so I'm thinking that with I think it is a very interesting question. The developing banks, I think in my head, I'm interpreting that as development banks. And one of the things when I actually left RBS a couple of years ago, I can only speak from a slightly academic perspective here, but I looked into microfinance, and I do think it's particularly important in a lot of the developing parts of the world. And I do think actuaries will be able to add a lot in terms of, putting these banks on a sufficiently commercial footing that they can actually provide the service that is required to help the communities they're working in. And I think in managing these trade-offs, the actuarial skill set will be very, very important. So I do see there being an opportunity there. Again, just from and this is my own personal prejudice perspective, I do think with something like the World Bank, I think actuaries could bring a very different perspective. I worry sometimes with these organizations that there's a degree of the kind of groupthink appears. I think an actuarial perspective would actually be a very good part of any of the teams working in some of these supranational organizations. And I think just bringing a fresh pair of eyes and a different way of thinking would be incredibly valuable. I think it'd be challenging to whoever does that. So I think the actuary doing it, it would be a challenge for them to speak the language and get traction with ideas. But I genuinely think bringing a different perspective would be incredibly valuable.
Yes, definitely. Thank you for that, John. And I guess, yeah, my perspective on this is very similar to yours, John, when it comes to development banks, that as much as they are banks, they do maintain a very strong social impact lens. And we're seeing a lot of that, I guess, mentality and narrative seep into other parts of, traditionally capitalist spaces. And so I believe although it's a space that we probably haven't thought about much in the past, it's not going to be so different from how one needs to think in a lot of other spaces going forward. So, whether you're working on a social impact bond, that stretches, different parts of the world, or you are building some kind of risk product, I think we are well placed to have a voice in the discussion, and we shouldn't shy away from areas that don't seem, traditional per se, because I believe that the narrative of social impact and generally impact investing is seeping into probably every industry at the moment. And I think as far as central banks are concerned, we can't ignore them. Fortunately, within South Africa, we have, and within the ASSA Banking Committee, we actually have several actuaries working within the central bank, and we liaise with them directly in terms of, what regulation is coming out, what standards are we coming out with, and as Jerome mentioned earlier, also contributing to how they think about developing frameworks, whether it's within climate change or whether it's within blockchain. They do actively seek out the voice of actuaries to contribute to those discussions. And I think the more of that type of work we do, I think we build the profession by being part of those conversations, even if we don't feel like we're fully equipped initially. I think one thing we've learned from this exercise, and I guess because it is something new, is that it's important to start. It's important to voice your opinions, even if you're not sure. It's important to start the discussion and to seek out people who know more or are as curious as you are. So definitely, I would say, even if you don't feel like you know all the answers or it seems new, just jump into it. Kathy says, must change profits model to have social impact, especially for the unbanked population. Yeah, that's exactly what I've mentioned now. But I think, within that discussion is also ensuring that products are sustainable. I think sometimes social impact is its own worst enemy because it doesn't align financial incentives correctly. So it's definitely important to have social impact lens, and in doing so, to make sure that the products are commercially sustainable. So yeah, that's my comment on that. I don't know if you two have any other comments on her point.
I would. I mean, the first thing I'd say is I think I entirely agree with where Catherine's coming from. So I've actually written a book on banking because I was so frustrated that the book I wanted to read didn't exist. So I kind of arrogantly thought I'm going to try and write it myself. But the opening chapters, the opening sections really ask the question of what do banks do for society and what do banks do for individual customers? And I think this goes to the heart of the question here. So in that, I'm very strongly believe that for the unbanked population, banking is essential. So I pick up the example in the UK with basic bank accounts. The difference that can make to somebody is maybe saving £300 a year or more on something as simple as utility bills. You know, the ability to use a direct debit to pay for your, your utility bills saves the poorest in society the most money, where it really matters to them. And as you look across, a lot of developing banks in the rest of the world, for somebody who's trying to set up a small business or, operate a small business, some kind of access to both payment and potentially credit is essentially important. So I really, really do think it's important. The challenge that I put down in my book is the flip side of that is what is the right level of services and what risks do regulators allow you to take? So the example out again, I'm going to use the UK here, but if we look at, basic bank accounts, you have to do the full money laundering piece for them in the UK. The services that you provide for them are very, very unprofitable for the banks and actually quite challenging for people to open. So I do think there needs to be a degree of pragmatism. So it might be limiting the services these accounts offer. So you get the right side of 80-20. So it helps the unbanked person to the highest possible degree while making it affordable for the banks to offer and also actually restricting the amount of money laundering you can do. So it might be that if the amount of money you hold in the accounts is low enough, you can do a lower money, laundering threshold. And if people want to do more and their banking requirements start to increase, you then go through the full money laundering. But I think this is a conversation where the regulators, the banks and society have to think very closely about the services banks are required to offer and that banks are required to offer to the poorest in society, because it's always the poorest who benefit most when they get access to banking. That's been true. I mean, when I've been writing the books, I've looked through history, and that's been very, very true throughout history.
Great, super. Ian, do you have any final comments before we close? All right, okay. Again, thank you very much to everyone who's managed to join us today. And yeah, I think we've run out of time. People have meetings that they need to dash off to. The recording, or at least one of the two recordings, will be available on ActiveView as well as on YouTube. So please do direct your colleagues to those recordings. And yeah, enjoy the rest of your day or the rest of your evening, depending where you are in the world. Thank you very much.
Just one thing. So I've seen another questions come in from Catherine. Catherine, I haven't yet figured out how to get onto my LinkedIn account or anything, but if you're able to get a hold of Kudzai, she could put you in touch with me. And it'd be a useful conversation, I think, to continue, elsewhere if that's possible.
Super. I will put you two in touch.
Thank you.
Thanks, guys. Bye.